module 5, and as I said, next two modules out of the probably skip 6 and 7 because that's appendix material. So I'm going to finish this module and then go on to the last one on research and development. But if you look at page 5, you'll notice there are 6 categories. You don't have to memorize these, obviously, but I'm going to go through them so that you understand what intangible assets comprise. And in addition to understanding that, knowing what the amortization might look like. So in the first case, we've got the marketing related. So the trademarks, trade name, company names, and these are indefinite life. Some of them can be renewed. These are not amortized. So these are indefinite life intangibles. Then if you go down to customer-related intangibles, we got something called a customer list. And as I said, if you buy, let's say, a brokerage firm, or if you bought a commercial bank, there's a list of customers, depositors, investors that you would pay for as part of the purchase price, and that's an intangible. A backlog of sales orders is also valuable. So if you have contracts, purchase orders, you kind of see this on Shark Tank a lot, right? They say, well, you got any purchase orders, you have any demand for the product, that can also be an intangible. Now, this has no life at all in a sense, but has no legal life, but it would have limited life. And you would amortize this using the lesser of the useful life or economic life, whichever was shorter. Useful life could be on a customer list, maybe 5 years, and economic life, depending on how you estimate that. So that would then fall into the category of finite life intangibles, or definite life intangibles. These are amortized. So now, before we go any further, I want to talk a little bit about the amortization process here. And what method would you use? So I'm going to tell you that we generally use straight line and no scrap line. To amortize these assets. So it's generally straight line without scrap value. The percentage of revenue amortization, which I'll show you a bit later, is actually preferred. So, percentage of revenue means that you would estimate, for example, how much revenue you generate from this customer list. Well, let's say it's $100, and if this year you actually sold $20 from that customer list, that would be 20%, and you would amortize by 20%. So it would be based on expected or estimated revenue. And then, as far as the useful life is concerned, useful life, as you can see, is generated either by contract, economic life, or useful. That has to be estimated. So you could have a contract, which would be legal, or an economically useful life. There's no real specificity with respect to how many years, but the FASB tells us there's a maximum. They recommend a maximum of 20 years. So they'll say don't bring them out more than 20 years. So the percentage of revenue, no, changes. Actually, when you use the percentage of revenue, you can use a higher of the straight line than the percentage of revenue. I'm going to show you that for software intangibles. All right, so let's take a look at another. Artistic related, which would be copyrights. And that would be the life of the creator plus 70 years. Again, useful life or economic life. So you think about writing a book, you know, the book may be popular for 5 years, you're not going to bring it out life of the creator of 70 years. So that would be the shorter of the economic life. Contract related, which would be franchises. Some franchises could be indefinite. If you have a renewable, automatically renewable franchise, licenses, permits. So again, here if it's limited life, length of the contract. If it's an unlimited life contract, it wouldn't be amortized at all. So a broadcast license could be either fixed or it could be renewable automatically. I mentioned this on Tuesday, that if you take your local affiliate television station from NBC, those broadcast licenses renew automatically every X number of years, so they would be indefinite in life. And finally, technology related, where you have a patent, 20 years, but again, you get a patent on anything that's technology related, you're probably going to have it lasting economically, or useful life might be, what, 3 years, 2 years? So even though the patent goes out for an extended period, you're going to have a limited period of economic life. Now, all of them are subject to impairment, which we'll talk about. And then finally, if we go back to our list, the last one on that list was goodwill. Goodwill is not amortized, but let me just tell you, that is for publicly traded companies. And I guess to make your life more difficult, there is a set of rules for private companies, privately held companies. It's a set of rules that's generated from the Private Company Council, as it's called, so PCC, and for private companies, can amortize goodwill for 10 years. So when we talk here, we're talking about publicly traded companies, but even if you eventually work for a very large public accounting firm, it doesn't mean you won't see privately held companies. I mentioned this at the beginning of the semester. One of the big four firms will audit companies like Goya Foods. It's a family-owned business. It's a privately held company in a sense. Even though it's as large as a publicly traded company, it is still family-owned, and as a result, could follow the rules of the Private Company Council. So PCC rules will tell you you can amortize goodwill for 10 years. So I would have to be specific if I asked you questions about goodwill. Now, what is goodwill? Well, we know that goodwill is not amortized. It is subject to an impairment test. We'll talk about that impairment test in a subsequent module. But goodwill in any, by the way, any indefinite life intangible, let me add this to our list. I will just say it's not amortized for publicly traded. Not amortized for publicly traded companies. Anytime you have an indefinite life intangible or goodwill, if these are not amortized, there's a high probability that they're overstated, like you're not amortized. And therefore, when we look at the impairment testing, the impairment test will be annual. So again, I'm going to repeat the logic. The logic is as follows, that if this is an asset that is not amortized, it's likely to be overstated. And therefore, they want us to check for impairment annually. However, that can get very expensive. So if you look at this option to minimize the annual impairment test for both goodwill, and we'll take a look at this in the next chapter, or indefinite life intangibles, there is a bailout, if you like, that's called the more likely than not test. More likely than not is slightly more than 50%. So if you look at impairment indicators, such as whether or not the company is subsidiary or the goodwill is valued at a proper amount, or an indefinite life intangible like a company name, if that still has value, an indefinite life franchise. So for example, what if you had an indefinite life franchise or an indefinite life broadcast license? Could that be impaired? Well, yeah. Think about terrestrial radio stations today that don't stream on the internet, right? How many of you actually would use an FM radio station if you could get streaming, right? So pretty much you got it on your phone, you set up the playlist that you want, so therefore you have a limited use for those radio stations. The broadcast license, even though it's an indefinite life, has been impaired. And lots of companies took write-downs for those indefinite life intangibles. So they can be impaired, but the impairment indicators would be trends like how people consume music, or how people actually listen to radio broadcasts, or a franchise. If you got a franchise for a product that's not selling, that's an impairment indicator. We'll go over those a little later. So if those impairment indicators indicate that it's more likely than not, slightly more than 50% chance, then you go ahead with the annual impairment test. If those indicators are not more likely than not, if the probability of impairment is lower than 50%, you don't conduct an impairment test. So we'll talk about that a little bit more. Now, what is goodwill? Well, goodwill is recorded only if it's purchased. So you may have a significant advantage over other companies. Your company name may carry with it the ability to charge more for a product than the industry average. So take Apple, for example. Right, their products may carry the name that is associated with quality, and maybe you would pay more for that product than you would for a comparable product. We probably do. You cannot put that on your books unless somebody buys Apple. Well, you have a company that's got extensive training, and all your employees are the best in that industry. Everyone is trained on a regular basis. The problem is the training cost and the human capital, in a sense, the value of your employees is something that someone might be willing to pay for if they bought your company, but you can't put that on your books. So unless somebody buys it, these intangibles cannot be recorded, and they're expensed. So training programs are expensed, right? So if you go out and you run your own company, you want to train your employees, you bring in a professional to train your employees, you have to pay for it, it's an expense. So goodwill has to be purchased in part of a merger and acquisition. And it represents the excess of what you paid over the fair value of the net assets you acquired. Now, we're not going to get into you'll see this more in the advanced accounting, but let's just take a look at what goodwill would represent. There's an acquisition cost for the target company. The target company is the potential subsidiary. You take the book value of their net assets. What are the net assets? Assets minus liabilities. Right? So that's their stockholders' equity. You pay more than book value. So let's think about this for a second. Why would you pay more than book? What do we know so far about accounting methods? Well, there's some income increasing, income reducing, asset increasing, asset reducing standard. It's very possible that the company is accounting for inventory in a certain way, LIFO, that understates it. They could be using accelerated depreciation, which understates their assets. So there's an excess that you pay over book value. That excess could be made up by looking at the undervaluation of those assets. Now, when you look at the undervaluation, that's only one aspect. There is also unrecorded assets. Now, this is typically the case. It could happen that it's overvalued as well. So, undervalued assets, for instance, under US GAAP, we don't revalue assets on land is at historical cost. The use of accelerated depreciation also undervalues net assets. Right? Unrecorded assets could be things like a trade name. Customer list. You're paying for a list of customers. So those are identifiable. So you can identify why you paid more. Now, we rule out that you made a mistake, but you could have overpaid for the company, right? So you now have an excess cost overrun. Let's assume that you've got write-ups of those assets. Whatever is specifically identified as either undervalued or unrecorded net assets is taken into account. Whatever you cannot identify becomes the goodwill. So what I want you to think about is that goodwill is a residual. It's basically something you can't see. It's something you can't identify. You know you paid for, let's say, location. You paid for reputation. You paid for something, but it is not identifiable. And it gets kind of dumped into this goodwill. It's a residual. You're also going to find out that you may be paying for, and you should know this from intro, and you're going to see this in the next module that we cover, is research and development. Research and development, how is it treated? Is it an asset or an expense? Remember from intro? Expense. Yeah, even though it is clearly an asset, it's written off because of the difficulty of determining the actual outcome of the research. But if you buy a company that's doing research, it's an unrecorded asset. You may be buying that company for what we call in-process R&D. So in-process R&D is also an asset. In-process R&D is an asset that you could record. So if you purchased a pharmaceutical company that's doing tons of research that they've expensed, you're going to pay a premium for that company to get that research. And that becomes an asset that you could record in the unrecorded asset category. I'm going to show you some numbers in a second. But whatever is not identified will fall to the goodwill. That is a residual. Now, is it possible to have a bargain purchase to pay less than fair value? Yes. And that's negative goodwill. Negative goodwill is no longer used in terms of that language, but it's a gain immediately. So if you buy a company and pay less than its fair value, and that happened during the recession, so lots of companies were picking up bargains by buying companies that were selling below their book value. So you're actually paying less than what the company was on their books at. And that gain goes into income immediately. All right, now let's put some numbers on. So let's say that you have the buy company pays $140,000 to acquire 100% of the common stock of the sell company. So this is going to be a 100% merger. It's assumed that plant assets, let's say factory, buildings, and land, and so on, of the sell company are undervalued by 40. That's all you know. So out of this grouping up here, you don't have trade names and customer lists and in-process R&D. You just have some undervalued plant and equipment. and it's undervalued by 40, and the historical cost, the stockholders' equity, the assets minus liabilities, is 80. So here's the way the goodwill would be calculated. You would take the purchase price for the target company, which is 140. You would subtract out the book value of the net assets you acquired. Now you've got an excess cost over book value. So why did you pay more for the company? That's the question. More than its book. Land, buildings, equipment was undervalued. That's all you can find out is 40. Whatever you cannot identify falls to the goodwill. Goodwill is the unidentified excess payment. Now, in the market, goodwill is not received very favorably, because what could it mean? You overpaid for the company, right? Just made a mistake. And in addition, what if there's bidding going on? More than one company trying to buy the subsidiary, right? It could be a bidding war which overstates the value of the company. So goodwill is not really a highly valued asset in the marketplace. And think about when you look at a home that's up for sale in your neighborhood. People are coming in, the real estate agent, and they start taking bids for the house. Somebody sees something in that home that they want. Maybe it's locations to school, maybe it's being near a bus stop, whatever it is, which I may have no use for, you may find it important, you bid up the price, you pay more than the house is worth, technically, and that's your goodwill, that's what you're paying. And that's what this represents. Now, in theory, when the investment banks do this, obviously, if they have been paying in excess, they've already mapped out the excess earnings. So they've already valued the goodwill. So they've already projected the ability of this company to generate income above and beyond what everyone else in the industry does. And not only that, what if you put the companies together? Are there any synergies, right? And the synergies, let's say, of Duane Reade and Walgreens. Now, that synergy may generate more income, and that becomes part of the goodwill. So all of that's got to be considered, but for us as accountants, this is the way we would see it. Now, what is the fair value? That's the next question. What's the fair value of the sub? If the book value is 80 and the assets are written up by 40, the fair value of the sub is 120. So if you look at the purchase price, of 140, and you look at the fair value of the net assets, it represents the book value of 80 plus the write-ups. That's 120, and 20 is the goodwill. So goodwill is really the excess price over the fair value of the net assets. In fact, some people don't even like to call goodwill goodwill. Maybe they're trying to trick somebody, but on the balance sheet, it will say excess of purchase cost over the fair value of subsidiaries acquired. This huge sentence is sitting on the balance sheet. And the reason why is because goodwill is really not something that you could be sure of as an investor. One other question for you. If you were buying this company now that has goodwill on its books, what would you value the goodwill at as a purchaser? So now you're buying, let's say Duane Reade and Walgreens have goodwill combined. Another pharmacy chain wants to buy the Duane Reade Walgreens franchise. What would they pay for the goodwill? Nothing. Because that goodwill is only valuable for Walgreens. They were the ones that made that purchase. So just like the home sale that I mentioned, you like the house location. The school district, you like the transportation, whatever it was that attracted you to pay that premium. Now I want to buy your house. I'm not paying for that. I don't care. I don't have kids in school, right? I'm not paying for that premium. So the goodwill you pay is personal to you, just like the goodwill on these financials is pretty much personal, or in a sense, firm specific. So goodwill is worthless in a marketplace. Now, new goodwill can be created, because now I see something else in this company that I want, and I'll pump up the price of it. Right? But the goodwill you pay, not worth anything to me. So, again, it's a tough asset to deal with, non-amortized, and we will have an annual impairment test subject to that, more likely than not, covered. Now, I'm going to tell you before we take any questions, is you do have some problems here with goodwill, because as I said, just know that it is, and you're going to see lots of this in advanced accounting when you do nothing but mergers and acquisitions, but questionable value. Goodwill is highly uncertain, and companies try to get rid of goodwill as much as possible. They try to load up on more identifiable assets if they could. So goodwill is not something you would think. You may think it's something people want, they don't. Right? If they pay more for the company, they want to show the readers, this is why I'm paying for it. And the other problem with goodwill is that there's what they call an earnings drag on this. So, for example, if you, in acquisition accounting in general, if you write up a building, if you write up inventory, when you depreciate the building, if you write it up, so let's say that 40,000 represented the building or an equipment, or plant and equipment, and you write it up by 40,000. When you start depreciating it now at the higher amount, what happens to the depreciation expense? Goes up, earnings drop. So one of the problems is that when we use acquisition accounting, everything's at fair value, not the buyer, but the purchase company revalues those assets. So you revalue what you bought, not your own company. Those revalued assets have a drag on earnings, and the other problem, of course, is the impairment. So goodwill, if it is overstated, could ultimately cause earnings to drop if we have to write it down. Now, that is goodwill. Any questions on the goodwill? That's how we get it. Now remember, I did say this, and I'll say it again, is that companies are just not throwing money at nothing. I mean, obviously, you go to an investment bank that puts the deal together, that values the purchase, and they are building in the future cash flows that they expect from things like company's reputation, the company's name, the company's quality products, the training programs. They're able to project higher cash flows for that. And then when they discount it back, they get a higher value for the company. So it's not that you're just paying for thin air, you're paying for something. Just that accountants have no way to put human capital on the books, so it falls to the goodwill. So this goodwill could include reputation. It could include the increased, this could include the present value of the increased earnings due to company quality. This can include the present value, the increased or excess earnings that you generate because of your employee base. This could be the quality of the earnings from the quality of your location, of your distribution system, whatever it may be. So there is something there, just that as accountants, we just see it fall to the bottom, and we call it goodwill. But actually the buyer knows that there's value. And that value, again, is only going to apply to the buying company. The buying company has a unique perspective with respect and strategically why they wanted to buy this company. It could be to penetrate a certain market. It could be to get international presence. Whatever it may be, it is going to come out into the goodwill. All right, so any other questions on goodwill? We'll do a whole semester of mergers and acquisitions. This will be a big part of it as well. Now, as I always tell you, IFRS makes everybody's life extremely simple. At the end of the modules in 12, I give you a list of the US GAAP impairment tests. There's about 6 different tests that you have depending on the asset. So there's a different test for finite life intangible and planned assets. There's a different impairment test for indefinite life intangibles. There's a different impairment test for goodwill. There's a different impairment test for natural resources. Under IFRS, there's only one impairment test that covers everything except goodwill. Goodwill is treated a little bit differently. So let's go through the impairment test now for IFRS. IFRS combines all impairment testing except goodwill into one, I think, relatively simple technique. They will take the carrying value of the asset and compare it to something known as the recoverable amount. So they will take the fair value, I should say the carrying value of the asset, and again, this is impairment testing. All assets except goodwill. That includes plant and equipment as well. So we would have the carrying value greater than the recoverable amount and that is known as, well, that would be your impairment loss. The recoverable amount is the greater of the net realizable value, that's the selling price minus disposal cost, and that's known as the value in exchange and the value in use. And I'm going to say, let's just take the discounted cash flow as an example. The selling price minus the disposal cost is sometimes called the value in exchange. And that's it. And I think it's a relatively simple test compared to what we're going to see in some of the U.S. GAAP accommodations. And the statement here has recently been changed. So you could reverse impairment losses. Let me just change this for you now. You only cannot reverse impairment losses for goodwill. Definite life intangibles are included. So let me just correct this. Make sure I highlight it so I don't forget. So recently, that's been changed. So we are allowed to reverse those losses. And let's go back, and I know hopefully you start to think about the final. Remember discontinued operations? When we reverse losses, we can reverse them only up to what? The original carrying value. Same thing's true here. So you can reverse these impairment losses if there are a change in economic conditions. So let's go through the example. This could be a plant asset. This could be any type of intangible. Well, let's just take it to finite life intangible. The cost of that intangible is $135. The accumulated amortization is $40. The fair value of the asset is $70. That's its selling price. And its disposal cost is $20. The company expects cash flows from the use of the asset, 40, 30, and 20, over the next 3 years, respectively. And again, let me just tell you here, selling price is also the same as fair value in our example. And the company's discount rate or cost of capital is 6%. So we're asked to see if there's an impairment loss. The first thing we do is we take the carrying value. Carrying value of the asset is the cost minus the accumulated amortization. So the carrying amount of the asset is 95. We now need to compare it to the recoverable amount. The recoverable amount is the greater of either the net realizable value, which is the selling price or fair value minus disposal cost, or its value in use. So we know that, let's go to the second one first, the value in exchange, as I'm calling it, is going to be 70, which is the selling price, minus the disposal cost, so the net realizable value is 50. What is the value in use? Well, again, we just did this with exam 3. If you think about the value of an asset, so we're saying it's 40, 30, and 20, the asset's going to last 3 years. What's its value today? The present value is the value of that asset in use, meaning that these are the cash flows that you expect to be generated from using that asset. And if your cost of capital is 6%, that is, if you got this money and invested at 6%, if you discount this back, the present value is 81.23. This is the value in exchange, in use value. So that's the value of the asset if you hold and use the asset. And that is 81.23. That's the value in use. What's greater? Value in use of 81.23. And because the carrying value exceeds that amount, there's an impairment loss. And the impairment loss is 1377. So the impairment loss is 1377. Now, final exam, I'll probably give you both fair values. Now, the important thing to note here is that the asset is still in your books at 95. So we have to write that down by 1377. How do we write it down? Well, in module 12, we're going to do a lot more on this, but let me just show you what would happen. First, any questions on this process? So IFRS is across the board, except for goodwill, all their impairments are exactly the same. You get the carrying value, compare it to the value in exchange, selling price minus disposal, or fair value minus disposal, or the value in use. The value in use is the present value of the cash flows expected from using that asset. I'm just showing you the calculation, tied it into what we just covered on third exam, but again, you could be given this number. Questions on the process. Again, it's something you have to know. This, again, is in IFRS. Goodwill is something we'll see in the next module. Pretty simple, actually, but this makes life very easy. US GAAP has different rules for impairment. Plant assets, finite life, indefinite life intangibles, and goodwill. So it's like 3 or 4 different, and natural resources, they got about 4 different impairment tests. Here, you got 2. So, much more simple. Now, let's look at the entry to write this asset off. This is an approach which we call the depreciation elimination approach. And we're going to look at a couple of approaches when we look at the valuation. One of the things that I have to make sure I get to, and I will, is IFRS revaluation. Revaluations of planned assets or intangibles are permitted under IFRS. They're not permitted under US GAAP. So you could take a plant asset, or you could take a piece of land each year and revalue it to fair value. And if it's a plant asset like this, So this would be, or intangible, I should say. Non-current asset. The intangible asset, an accumulated amortization. In this case, it was at a cost of, the original cost of this asset was 135, right? And it accumulated was 40. All right, so what we're doing is we're going to do the following. We're going to use what is known as a depreciation elimination method. What we have to do here is wind up with 8123. And under the depreciation elimination method, your target here is to make that 0. So in order to get there, your adjustment will obviously debit accumulated by 40 and credit the asset by 53.77. So the approach you need to take is to eliminate the depreciation or amortization completely, and then make sure you take enough out of the asset to cover the loss. All right, so any questions on this impairment testing? And now, incidentally, the new amortization will start, when there's 3 years left, will start at 2708 beginning in the next round of amortization.
Do we have an account for impairment loss? Or is
Impairment loss is a loss on the income statement. It's part of income from continuing operations. And I think when we've been going through our sample financials, you've seen those line items on the income statement, and the next time we see it, I'll point that out. Questions on the impairment? Yeah, we're not going to cover any appendices, so we're going to move right to our last module and get to the research and development, and then we'll spend a little bit of time in the next module on the US GAAP. Now, by the way, I'm going to do I'm probably going to do a video this weekend, and I'm going to go through all the questions in the back and try to get you some other kind of self-assessments. Well, no, it wouldn't matter. I mean, if the numbers were the same. Yeah. So any difference in here will change the recovery, but it won't change the process. All right. Any other questions?
Do we use NRV if NRV was higher, correct?
Yeah, that was the value. But again, we look at both. Actually, the terminology is more like, this is US GAAP terminology, but it makes more sense to me to, rather than just tell you, NRV versus a discounted cash flow. You could also have in here the value in use. You could have had a market value for the company. Let's say you're doing an intangible that relates to the entire company. You could look at the stock price or something to see what the assets worth. So I like to use the terms value in use, value in use. All right, so let's go to the last module. This is going to be covering some important intangibles, research and development, and software development. Those are learning objectives. Now, why do we cover intangible? Why do we cover R&D in intangible assets when generally they are written off for their expense? So we know that all R&D is expensed as incurred, but there are exceptions. Number one, we're going to see this on a table in a second. If the research you're spending or the money you're spending on research has alternative future use. This is Module 8, page 1. Module 8. We're not doing anything on the other two modules. That's appendix material. In Module 8, page 1, we look at R&D. R&D is expensed as incurred with two exceptions. Number one is if the R&D has alternative future use. That is, if you can use the research in multiple projects. And that could happen. So if you're looking at a pharmaceutical company and they buy some testing equipment, and that testing equipment can be used in several different pharmaceutical trials or tests, that is an asset. It's not an expense. You also capitalize R&D if it is going to be purchased from an outside firm and it has a patent or it has alternative use. If you do research for another company, then it's a receivable in a sense, because then you've got income. So all R&D is expense with the exception of alternative future use, unless again you buy it or provide it for the outside. Now again, the rationale is, I'll just summarize that, the rationale is pretty simple. Research and development is going to be related to projects that have a very uncertain outcome. So you're doing research with respect to a new pharmaceutical product, a new technological product, the outcome is uncertain. Now, there could reach a point where you do know that, yeah, it may be a successful project, but accountants took a conservative position. And they decided that it's probably better to expense all of the research rather than try to pick and choose with judgment, right? Who's going to make that judgment if the product is going to be successful? So U.S. accountants felt that this was kind of difficult to do and pretty subjective. So we decided to expense all of the R&D. As always, IFRS has a little bit more of a practical solution. So when we look at this, by the way, this broke up a little bit. I have to post this on Blackboard. I know that your copy of this did not come out clean. So I'll just tell you, I'll copy this, I'm going to put this up on Blackboard. Research activities is a planned search, critical investigation that we're trying to find new knowledge. It's kind of a fishing expedition, right? You have an idea, you think something's out there, you start to put the time in, so you got laboratory research, trying to discover new findings or applications of those new research findings. Under U.S. GAAP, this is expense. Under IFRS, this is expense. So all research is expense under both U.S. GAAP and IFRS. Well, what's development? Development is translating that research into a plan or production process. And this is, pilot projects or prototypes. Here's the difference. Under U.S. GAAP, this is expensed also. So U.S. GAAP expenses both research and development. IFRS expenses research. What do they do with development? They capitalize. It's an asset. So for IFRS, when you get to the development point, you're actually really looking at economic viability. So this is the key phrase, that once you've reached a point of economic viability where you have products moving through different stages, once you hit that stage and you know that this product is going to be able to be produced according to specification, and we're going to be able to market this product, and we're going to get approval from the Food and Drug Administration, then the continued expenses on that should be what? An asset. And that's what we say under IFRS. Under U.S. GAAP, there are some exceptions which we'll talk about, but primarily that is expense. And you have to remember, R&D does not include routine maintenance, routine troubleshooting, and quality control. So when you look at the list, and this is US GAAP, you have to consider whether or not the product has alternative uses or not. So if you buy materials, equipment, and you put up a facility and it has no alternative use, that's expensed as R&D. If it has alternative use, it's part of inventory, and as they're consumed, of course, they would be expensed. If it was a building or a factory setting or a testing facility, have you ever seen, I always found fascinating how they test automobiles. You know, BMW will put a car in a facility and drop the temperature to like 150 below zero and see if the car starts. You know, or they'll have wind tunnels to try to see if the car can be made more aerodynamically and save on gas. What gas mileage would you get? So those simulators could be used whether they're making a BMW this year or in 3 years from now, perhaps. So that facility is going to be an asset. It's not going to be expensed. The most important thing here, remember though, is when you expense these inventory items and when you depreciate that asset, it goes into R&D. So if you're looking at a problem that says, hey, we got a research facility, a building, and we're going to start to depreciate it, you don't debit depreciation expense, you debit R&D expense. So it's part of research and development. Any type of personnel at work would be expensed. Any type of purchase tangibles, if it has no alternative use, you expense it. If you buy it, remember we talked about in-process R&D, right? You're buying it from another entity, that would be an asset. You also have any services. So if they're performed by others, they're generally expensed, they don't have any future use. Remember, if you do research for somebody else, you're selling a product, you have a receivable. And other indirect costs could be materials, supplies, and those would be expensed unless they have alternative future use. Now, showing you how this works, let's do an example. And this again is US GAAP. And we now have a list of research activities taken by a pharmaceutical company. So they have testing materials that they use in experimentation, 123,000. They have laboratory technicians, 438,800, that's their salaries. They have general purpose testing equipment that they acquired in on January 1 of the year, current year, and has a 10-year life. They pay consultants, outside consultants, $33,090, and their total expenditures are $1,359,400. So the question then becomes, what would you do in terms of accounting with respect to those expenditures? What is with alternative future use and what has no additional use for this company? If you look at all of those items, which one could be used again? Well, if it's general purpose testing equipment, that could be used in the future. So this would be capitalized as an asset, and the other three would be expensed. So you'd have to expense them without any alternative future use. So what would happen here is that you would take the R&D expense would be the materials used, salaries, consulting fees, for a total R&D expense of $598.90. The testing equipment of $768,510 is going to be an asset. It's going to be used for multiple projects. So you would debit the testing equipment and credit cash. Now, with respect to IFRS, depending on where this project is, what phase it's in, and what gate it goes through, a lot of companies use what is known as a lane gate approach. So you've got these lanes of all your research projects, and as they pass through certain gates, so to speak, as they get closer to technological feasibility, they may become assets. Here, we're not using IFRS, we're expensive. This would be true on the both set of standards. Now, when you depreciate this asset, let's say it's 10 years, no scrap value, 768, 510 divided by the 10 years, gives you 76,851 of depreciation. Notice that you would debit R&D expense and credit accumulated. Right, so the only thing I'm saying here, just from the standpoint of making sure you get this right without losing points, you don't debit depreciation expense here, you debit R&D. So it's classified as R&D. So once again, alternative future use is the driver for the most part. If you buy it from somebody, certainly it's an asset, especially if it is patented. So any questions on the R&D? Now, there are going to be some exceptions, which we're going to get to right now. At least one of them. In-process R&D. In-process R&D is an identifiable asset, one of those assets that were unreported that you pick up when you buy another company. So let's assume that you bought this pharmaceutical company, all of those R&D expenses that were charged over the years would reduce their net assets. But if you buy an in-process, underdeveloped technology, you now have an asset. That's what you're paying for in the merger. So 5 items to note. R&D that is purchased in a merger and acquisition in process is considered to be an indefinite life intangible until the product is completed. The amortization would begin as soon as the project is completed and successful. Any cost that you spend, so if you bought research from another company, but now you continue to work on it, you expense it. So let's say you paid $1,000 for in-process R&D. Every year you spend another $10 to finish it. When you're spending that $10 to finish, it's expense. Then once completed, everything else gets expensed. So any other future R&D on any other project. But if you buy it, put it on your books, and you find out that it is in fact without value, of course you can go there. IFRS is pretty much the same, except that they want to be sure that the definition of their definition of an intangible is met. That is, having future value, and so on. All right, so that's in-process R&D. So if you buy it from someone, and we'll look at Johnson & Johnson in a second, especially if it has patent potential, it would be an asset. Now, if you go to J&J, on the next page, I've highlighted 2 things, or at least one. You can see the research and development. Notice that research and development is a very significant part of their expenses, and they've also now are writing off some of their in-process R&D on their income statement. So they're writing off some of it here. So they've got internal R&D plus the expensing as they're finishing, perhaps, some of the in-process R&D that they purchased. One important thing to notice is that R&D is prominently displayed, and you would think as a strategy for a company like Johnson & Johnson, you would want people to know what you're spending on research. And I think I mentioned this in the first week of class when we looked at certain income reporting strategies and the way the market reacts. This has been around probably, I don't know, this R&D expensing. It's probably about 45 years ago. Before that time, you would always call R&D an asset. This was the problem. In the United States, all research and development was considered an investment. So you have to remember, picture yourself as an auditor going into a company and saying, okay, you got $6 million of research sitting on your balance sheet as an asset. What's the prospect here? Well, they can write up lots of documents and convince you that it's an asset, and then maybe it is, maybe it's not. So with that uncertainty, they decided to expense it. In that year, it was about 1972, I think, historically, in that year, when they decided to expense all that research, huge chunks of income were being absorbed by these charges. What do you think happened to the market? How did the market react? You would think it would go down, but it didn't. Right? The market was smart enough to read this as an investment. So regardless of what accountants call it, there was zero, actually a flat reaction. All the research, this was a hot research topic. Everybody was researching this. Let's see what happens. So expensive R&D. This has to be catastrophic, and nothing happened. Why? Because the market understands that whether you call it an expense or whether you call it an asset, two things are true. Number one, it's an investment, and number two, it's a cash outflow. So whether that cash outflow is income or whether it is an asset doesn't really matter. So this didn't affect the market at all. Now, it's not always true. Again, that would have been my first reaction, and I was surprised to hear the result as well. So that's why companies prominently display research. Johnson & Johnson, Apple, these companies are going to be sure that you know how much they're spending, and really the word is how much they're investing. So they'll tell you that R&D is expense as incurred, upfront and milestone payments made to third parties in connection with research collaborations are expensed until they get approval. So here's an example where you're buying research from someone else, and as I said, you can't call it an asset unless you got regulatory approval. And the same thing's true is here. Okay? You got an intangible asset. They also tell you how much research is as a percentage of their revenue. And they do it by division. So extremely important for Johnson & Johnson to be sure that you know how much they're investing in research. And in fact, if you read through this narrative, it's going to tell you that the company continues to invest. It's committed to investing in research and development. So regardless of what we call it, it is in fact an asset. And then they're telling you with the in-process R&D, I guess they had some write-offs there, and some of it may have been some of the companies they bought. And I don't know if you know, but Johnson & Johnson actually has an R&D department, an M&A department. So they actually have an entire department devoted to acquiring other companies. And a lot of companies have that, where you're always looking to bring in. I'm sure Apple does as well. Most of Apple technology was acquired. Touchscreen technology and all of that, the voice, the Siri, the voice recognition, all of that is purchased from other companies. So same thing here, and the in-process R&D, if it does not prove to be profitable, it gets written off. Now, with all that said, patents, interestingly, are pretty much very, very nominal. Unless you buy a patent from somebody else, the intangible asset patent only consists of fees to defend, filing fees and legal fees to defend the patent. So most patents would be of very, very nominal or a minimal valuation. So surprisingly, you might think that patents would be a huge amount on companies' books. Unless they buy them from someone else, there's not much out there. All right, so that's pretty much US GAAP, and we know that IFRS will have this break point where once there's a technological feasibility or economic viability, they'll call that research an asset. Now, in the United States, we do make an exception, and we make that exception for software. We make that exception for software. Now, don't know why, except that I could guess that maybe if you thought about where the U.S. economy might have an advantage in some ways, it would be in what? Technology and software development. So maybe this is a political move on the FASB's part to say, let's help these companies show higher earnings, even though, as we just said, we know that maybe the research does not necessarily affect market prices. So when you manufacture software for sale or lease outside of your company, under the codification, you see the section there, again, you're not going to memorize them. We look at external software being developed in 3 stages. The first stage is R&D expense. And you will expense all your costs. This is absolutely parallel to IFRS for all R&D. We make this one exception for software. So let me say that again. IFRS is just like this: technological feasibility or economic viability. We only make the exception for software. So we're saying that up to the point where technological feasibility is established, you expense everything. Expense everything until you are at the point of technological feasibility. That is planning, designing, writing the code, and testing the software, anything you need to do to determine that the product can be produced according to specification. Now that point will vary depending on the company. And here's the problem with this. Companies will have the next step, where once technological feasibility is established, all future costs get capitalized as an intangible asset called software production or software development cost. That's completed versions of the software, the documentation, whatever it is. And again, we try to amortize these. We'll talk about percentage of revenue. I think I had a question about that as well. And then if you actually sell software in packages, sometimes you still do, but this would be the cost to maybe upload the software, get a downloadable version of it for the internet. If you want to buy the packaged software yourself, maybe on CDs or USB drives, whatever it is, that would be inventory, and that would be capitalized. But what I wanted to say with A and B, that break point where you reach technological feasibility is different for each company, right? So just think about a company like Microsoft. If they're upgrading Windows, they know almost immediately that they've reached technological feasibility. So they should be expensing very little and capitalizing a lot. But it depends on the company. You take EA Sports with video games, right? I mean, they're doing the same thing. They may reach technological feasibility faster or maybe later than their competitors. And it depends on, really, it's kind of tough to judge as an accountant, but it really depends a lot on their income reporting strategy too, right? So I might say, well, we're not comfortable saying we've reached technological feasibility yet. We want to expense this another round. Now that'll lower your earnings. And maybe we'll say we reached technological feasibility sooner, right? And we've already met that. And if you look at, these video games, some of them, the marginal difference from one year to the next is nominal. Right? So you probably have to expense very little to get to those points. Now, let's take an example. And this is a perfect example of what you would see under IFRS for all R&D. You wonder why we don't do this for other research and development? Well, maybe we will. So it tells you that we've got Microfine Associates, and they've spent this year $1.8 million in planning, designing, testing phases to develop a new spreadsheet program for sale. After it was determined that the software could be produced according to specification, another $2,350,000 was spent to create product masters and completed versions of the software. Software documentation, development and training was another $250,000, and then printing, documentation, duplication, packaging. And that would include, as I said, the creation of a downloadable version of the software would be part of that as well. It tells you that we estimate a 4-year life. We know residual on the software intangible. And it says, we believe that they will generate $10 million in total revenue. And the first year that they went to market, they sold $3 million. So the question is, and I would ask the question, well, how much the expense? What's the R&D expense? What is the software development asset? And then what's the amortization? Well, the first thing is that you would have to expense all of the costs that would be incurred to reach technological feasibility. And we know that we spent $1.8 million to reach technological feasibility. That is an expense, so that gets expensed. The other costs after technological feasibility, we had planning, we had the actual product masters, the duplication. That came out to $2.6 million. And that becomes an intangible asset software development cost. And let me make sure you know that this is an intangible. So that's an intangible asset. It looks like a cost, an expense, but it's not. And let's say you put $500,000 in inventory, and that would be your total payment. So, and then by the way, this is a finite life intangible. It's a finite life intangible. It will be amortized. Now, finite life intangible is subject to amortization. As I said here when we started this morning, that the amortization is generally straight line with no scrap, but the preferred method is a percentage of revenue technique. This is not used very often except in the software industry. So let's take a look at how you would amortize this. You would amortize this by using the greater of each year. Someone asked this question, the greater of either straight line or percentage of revenue. So the software development cost for the software asset was $2.6 million. It had no scrap value, has a 4-year life. That's going to be, with respect to depreciation or amortization, that's going to be $650. So straight line amortization is $650. What's the percentage of revenue? Each year, you do this every year. You take your actual sales divided by the estimated total sales. Now, does that change? Yeah, estimated total sales will change each year. Change each year. Now, of course, you can't depreciate more than the cost of that asset. 30% is the ratio of actual sales to estimated total. You take 30% of the cost, and you depreciate or amortize 780. According to GAAP, you have to use the higher of the two, and you would amortize 780. And you just debit the amortization expense, and then credit either computer software costs directly or accumulated amortization. So it's the greater of the two. CZ1, intangible assets, over here. Is that right here? Straight line, yeah, but I used the wrong number?
No, just asking why we use 2,600.
Down here? Is that?
No, because of the calculation of the percentage of revenue.
Yeah.
You use 2,600 to calculate the amortization. She want to know why 2,600.
2,600,000 is the cost, right?
Of the asset.
Yeah, the asset. Yeah. That's what we use to amortize.
Why not add inventory? That would be my question.
Oh, inventory? Oh, that's going to be only expense as it's used. So as you, let's assume you've got downloadable software and you want to have the option to buy. Some people still buy packaging. So if I'm buying a packaged software, when I sell it, it's part of my cost of goods sold. The 2.6 is what you capitalize. That's what you have to amortize. You would not amortize the inventory. The inventory is like any other inventory. When you sell it, it goes to the cost of goods sold. Good question. Now, last thing to say here is that it's only going to be for this year. Next year, you're gonna start the process again. Straight line versus percentage of revenue. Now, last thing, and then we'll get these exams after. And that is, this may sound even more strange, but we also make an exception for internal software. Oh, I'm sorry. No, it's okay.
Straight line is not gonna change.
Now,
Straight line won't change, so I'll make that calculation for your own.
yeah. Well, but next year, you would have to take, what you would have to do is take 2.6 minus the 780, and then divide that by the remaining 3 years. Right, so that won't change. It's got to change. Because you're not going to get 650 next year. You're going to get 2600 minus 780 divided by 3. And that'll be, then the next thing would be the 30% of book value, whatever's left. 2.6 minus 780. So you can't,
I'm using my new bike.
yeah, gotta use net book value. So every year, it's almost like a change in depreciation method. When you change, you always start with net book value. Good question. Right. Internal software. What if you manufacture the software? What if you produce software for your own use? Same story. We're able to capitalize anything after we've reached the preliminary project stage. So let's say that one of the public accounting firms, one of the big four, is developing software for, let's say, audit analytics. And that software is going to be cost of salaries and materials will be expensed up to the point that you've completed the preliminary project stage. The preliminary project stage is like technological feasibility. So everything's expensed up to that point. After it becomes an asset. All right, so here's Microsoft, and Microsoft tells you they go through the same thing. They basically repeat the standards. Technological feasibility is the point that they would capitalize software. It says here, generally, this occurs shortly before the products go to production. Pretty interesting that this sounds like they're expensing a lot more than most companies, right? It's almost waiting until the product is completed. Then they also disclose their R&D as a percentage of revenue. It's pretty interesting. It's almost the same, or very similar to J&J.